What if a $200,000 portfolio could generate around $1,000 a month in passive income? The first step isn't chasing high returns. It's understanding the income math. Monthly passive income depends on both portfolio size and investment yield. Many investors combine dividend-paying investments, ETFs, and other income-producing assets. Diversification helps reduce dependence on a single investment source. Reinvesting income early can significantly accelerate long-term growth. Time is one of the most powerful tools an investor can use. Successful passive income portfolios are usually built over years, not overnight. The goal is building reliable cash flow while protecting long-term growth. Let's break down a practical strategy for building a portfolio designed to generate passive monthly income. To generate about $1,000 per month, your portfolio needs to produce roughly $12,000 per year in income. That means your average portfolio yield becomes one of the most important numbers. For example, a higher yield generally requires less starting capital, but it may also involve greater risk. That's why experienced investors often prioritize sustainable income instead of simply chasing the highest yield. Diversification helps spread income across many different investments. No single investment should determine your entire monthly income. A balanced portfolio can combine growth potential with regular income. Many investors also reinvest dividends while they're still growing their portfolio. Over time, that reinvestment can significantly increase both portfolio value and future income. Now let's look at how to structure a $200,000 portfolio for reliable passive income. One common approach is to divide the portfolio into different income-producing categories. Diversification helps reduce the impact if one investment underperforms. Dividend-paying companies can provide regular cash flow while still offering long-term growth potential. Broad market ETFs add diversification with exposure to hundreds or even thousands of companies. Some investors also include bonds or cash equivalents to help reduce portfolio volatility. The right allocation depends on your goals, risk tolerance, and income needs. There isn't one perfect portfolio that works for everyone. What matters most is choosing a strategy you can consistently follow. Consistency often has a greater impact than trying to perfectly time the market. Next, let's build a sample $200,000 passive income portfolio step by step. Here's a simple example of how some investors structure an income-focused portfolio. A diversified core can provide broad market exposure while supporting long-term growth. Income-producing investments can add regular cash flow alongside that growth. Combining different income sources may help create a more resilient portfolio. A small cash reserve can also provide flexibility when markets become volatile. Many investors review their portfolio periodically instead of reacting every day. Rebalancing can help keep your investments aligned with your long-term plan. The objective isn't perfection, it's maintaining a disciplined investment process. Discipline often becomes one of the biggest advantages in long-term investing. Next, let's see how compounding can dramatically increase both your portfolio value and passive income over time. Now let's see why compounding is often called the eighth wonder of investing. Compounding means your investment earnings begin generating their own earnings over time. At first, the growth appears slow, but over many years it can accelerate dramatically. That's why starting early can make such a significant difference. Even modest monthly contributions can grow substantially given enough time. Consistency often matters more than making one large investment. Automatic investing helps many people stay consistent through changing market conditions. Removing emotion from investing can improve long-term discipline.
Many successful investors focus on the process rather than daily market predictions.
And that's how a disciplined strategy can gradually transform a portfolio into a reliable passive income machine. Once your portfolio begins producing steady income, the next decision is how to use those cash payments. Some investors reinvest every payment to maximize future growth. Others use part of the income while continuing to reinvest the remaining amount. The right approach depends on your personal financial goals. That's why having a clear investment plan can make every decision easier. A written strategy can also reduce emotional decisions during market volatility. Successful investing is often about following your plan, not your emotions. Over time, consistency can become one of your greatest investing advantages. Small actions repeated over many years often produce remarkable results. And that's the foundation of building long-term passive income with a well-designed investment portfolio. As your portfolio grows, your passive income has the potential to grow with it. Higher portfolio value can create greater income potential without constantly changing your strategy. Many investors increase contributions whenever their income grows. Even small increases can make a meaningful difference over many years. That's the power of combining consistency with time. Passive income isn't built in weeks, it's built through years of disciplined investing. Patience allows your investments to keep working even while you're not actively managing them. That's one reason automation has become so popular among long-term investors. The easier your strategy is to maintain, the more likely you are to stay invested. Next, let's explore the biggest mistakes that can slow down your passive income journey and how to avoid them. One of the biggest mistakes investors make is chasing the highest dividend yield they can find. An unusually high yield can sometimes be a warning sign instead of an opportunity. Sustainable income is often more valuable than the highest advertised payout. Another mistake is concentrating too much money in one company or one sector. Diversification helps spread risk across many different investments. Trying to perfectly time the market is another challenge many investors face. Many long-term investors instead focus on staying consistently invested. Consistency often beats emotional decision-making over long periods. Avoiding common mistakes can be just as important as choosing great investments. Now let's bring everything together into a practical, long-term passive income strategy. The most successful passive income portfolios are usually built on simple habits repeated consistently. Regular investing often matters more than trying to find the perfect investment. Over time, diversification, patience, and discipline begin working together. That's how many investors gradually transform investments into recurring income. Income today can become even greater income tomorrow through reinvestment. Eventually, your portfolio may begin working harder than your monthly contributions. That's when compounding really begins to reveal its full potential. Years of patience can create opportunities that are difficult to achieve any other way. The key isn't getting rich quickly, it's building wealth steadily. And that's exactly how many long-term investors approach passive income investing. So what does this mean if your goal is earning about $1,000 per month in passive income? It means focusing on a strategy that balances growth, income, and risk. Diversification can help your portfolio remain resilient through changing market conditions. Consistency gives your investments more time to benefit from compounding. Staying invested allows your portfolio more opportunity to participate in future market growth. Short-term volatility doesn't always change long-term investment goals. Over many years, small, disciplined decisions can lead to meaningful financial progress. And a disciplined, diversified strategy gives you a solid foundation for that journey. That doesn't happen overnight, but disciplined investing can steadily move you toward that goal. The combination of diversification, consistency, and patience has helped many investors stay focused for decades. Simple investing strategies are often the easiest ones to maintain for the long term. The goal isn't to outperform every investor, it's to consistently make progress toward your own financial goals. Every contribution, every reinvestment, and every year invested can help strengthen your portfolio. Building wealth is often about making good decisions repeatedly, not finding one perfect investment. And that's a strategy that can continue working long after today's headlines have disappeared. Stay focused on the long term and let time become one of your greatest investing partners. Thanks for watching. If you found this guide helpful, subscribe for more investing strategies